Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, earnings season rolls on. We'll take a look ahead to results from the chip maker at the center of the artificial intelligence boom on Wall Street, Nvidia, which just became the third most valuable company in the S&P 500. I'm Tom Busby in New York.
I'm Stephen Carroll in London. We're looking ahead to London, Milan and Paris fashion weeks as the luxury sector faces cooling demand for its products.
I'm Doug Krisner, previewing the next move from the Reserve Bank of Australia.
That's all straight ahead on Bloomberg Daybreak Weekend. The business news you need to wrap up your week. Available on Apple, Spotify, the Bloomberg Business app, and everywhere you get your podcasts.
Good day to you. I'm Tom Busby, and we begin today's program with earnings this Wednesday from Nvidia. And for more on what to expect, we welcome Bloomberg Technology co-host Ed Ludlow. Ed, Nvidia this past week edging past the market value of Amazon.com, then Alphabet worth $1.8 trillion. Is this unstoppable, this company?
It seems unstoppable. It seems like a juggernaut, right? And when you look at what Wall Street expects them to say when they post earnings next week, there are no signs that will stop. You know, there's a lot of misconception and a lack of understanding about why Nvidia has been on the tear that it has. And when we talk about Nvidia in the AI context, what we're literally talking about is that the AI development, the building of large language models, it requires just hundreds of square miles of data centers, just racks and racks of servers, and those servers are basically lots of big boxes that get stacked up on one another. And those boxes, you can think of them like supercomputers. So, you know, the listener at home has maybe a desktop, and it's a sort of rectangular-shaped box. Think about something that's 10 times the size of that, and then take that box and times it by 1,000. And NVIDIA's role in that is that they provide the brains in that box, the GPU, or AI accelerator. And all of the money that's flowing into AI to build out that infrastructure, the reality is that you've only been able to build it with NVIDIA products. And until very recently, there was no one else on the market doing that. So the numbers are that Wall Street sees revenue growth of 369% year on year in the coming quarter. I'll repeat it, 369% top-line growth. And what's so astonishing is that last quarter, they had 280% top-line growth year on year. So it just doesn't seem to be tapering out yet.
And the shares are up 230% in the past 12 months. So it's everything is just coming up roses for this company. But who are NVIDIA's biggest customers and who are its top competitors? Yeah,
I mean, the question of who the biggest customers are goes right to the explanation I gave on how AI works in the real world. And the short answer is the hyperscalers, the cloud companies that own, operate, and control the data centers. For the most part, that means Microsoft Azure and NVIDIA powering AWS, which is Amazon's cloud business. The other big player is Google and Google Cloud Platform. But remember, Google's done a bit of work with its own custom silicon. But for the most part, even if you see a news headline like, for example, Anthropic, which is a really big AI company that makes a generative AI product, is powered by NVIDIA, we don't mean that the CEO of Anthropic knocks on the door of NVIDIA in Santa Clara and says, "Hey, can I have a big bag of chips, please?" and throws it over his shoulder and off he goes to make AI. The reality is that you're still reliant on a hyperscaler, and that NVIDIA ships those H100s, they're called, to the cloud provider and the data center that they go into, and the AI company never has direct contact with NVIDIA, but it's kind of a triumvirate. You have NVIDIA providing the hardware, the hyperscaler that runs the data centers operating it, and the AI company basically pays for the compute, pays for use of that cloud capacity.
And who competes at that kind of level with NVIDIA?
Yeah, so for quite a long time now. And when I say that, it actually is not a long time. It's basically 2 years, because all of this has happened in 2 years. Nvidia has been the only name where they're actually building at scale these GPUs, graphics processing units. And in very simple terms, a GPU can make lots of mathematical calculations in parallel at once. That's why they're good for training large language models or building AI. AMD has recently come to the market with a similar product called the MI300 series. But you don't just sort of start building these in huge volumes. It takes a really long time to ramp. And as you know, there's been a chip supply crunch in the post-pandemic era, which has impacted that. So AMD is slowly ramping. The principal difference between the two of them is that AMD realizes NVIDIA's got a real hold on this market for training large language models. But once you've trained the model and you want to start actually running the technology in the real world, have consumers using generative AI tools like ChatGPT, or start integrating AI tools into your own software, you then move to what's called inference. In other words, getting a response from the model. You ask it something, it gives you a response. And AMD is basically saying, ours is going to be better, because what they all have in common is it's incredibly expensive to do both of those functions. And so there's a battle that's brewing now as the market shifts from training models to actually using them in the inference stage. And it'll be interesting to see if AMD starts to take some market share.
So what's next for NVIDIA? How do they pivot now?
Well, I think they just keep going. I mean, you guys may have seen that I did an interview with NVIDIA's CEO, Jensen Huang, last week, or the end of a couple of weeks ago. And the next big market is what Jensen's calling sovereign AI. So right now, all of the financing and activity behind AI is being done by the private sector, big tech companies. But there is an academic school of thought that because of how impactful artificial intelligence will be on society, governments should have their own operations, right? Governments should have supercomputers and data centers that they control, that is training large language models, that is giving some kind of national level AI competence. And Jensen's been flying around the world to every region, speaking to the leaders of those nations and doing deals. Saying, let's collaborate. We can do something where we sell directly to you. That doesn't really show up in the financials yet.
Wow, a lot to look forward to. Well, our thanks to Bloomberg Technology co-host Ed Ludlow. Thanks for being here, Ed.
Thank you very much. Happy weekend.
And now we turn to the Fed, and minutes from the January meeting of the FOMC will be released this coming Wednesday, and policymakers voted to keep benchmark lending rates unchanged at that meeting for the fourth time in a row. So what will they reveal, and how soon will the Fed pivot to cutting rates? For some insight, we welcome Bloomberg International Economic and Policy Correspondent Michael McKee. So, Michael, what are you expecting to see in these minutes?
You didn't need me. You just answered the question. That's what people want on Wall Street to find out, is when and under what conditions will the Fed start lowering interest rates. And I'm not sure they're going to get a complete answer. We have heard from a lot of Fed officials since the meeting that they thought the news was good on the economy and things were progressing towards the 2% target, but they're not there yet. And so they want to see more good news, which just basically means they need more months of data. How many months? Well, they're not sure of that either. They have to wait and see how the data comes in and whether it is in any way confusing. So when you're looking at the minutes, you'll probably see something along the lines of most members agreed that progress had been made, but there's not going to be anybody who says it's time to cut.
Oh boy. Well, let's talk about some of the data we have seen, and we've seen a pretty robust labor market, although seen a lot of especially in the tech sector, job cuts nowadays. Consumer demand has been good. Spending, not as strong. Sustained economic growth. The soft landing. I mean, all of that is pretty good.
Well, we've had a week where the data sort of contradicted each other when you're thinking about it in terms of the Fed. We had a strong CPI number, which took a lot of people by surprise. And, of course, raised questions about whether inflation is going to be coming back or not. Inflation could be driven by a strong economy, which we had been seeing, and then we got the retail sales numbers that showed a lot of weakness. Some of that may have been weather related, and it may reverse in the next month, which would be another argument for waiting on the Fed side. But if the economy is weakening, then you would assume there would be less inflation, and we'd be more on the path that the Fed wants to see. The jobless claims numbers came in down this week, which is a bit surprising given what we have seen and heard in the layoff announcements. But it does suggest that the labor market is still strong, and as long as the labor market's strong, people will be spending. It's only a question of how much.
Yeah, and the high inflation that we're seeing, I mean, that's affecting certainly housing, business, borrowing and infrastructure spending. So what else is it affecting negatively?
Well, this last month's numbers were kind of distorted by the weather, so we know there's some issues in there. But inflation is making a difference in housing, definitely, because we've been expecting housing prices to come down in the CPI and the PCE, and they haven't really done that. They actually rose in the CPI numbers, and so Fed officials are a little confused about that, as is everybody, why we see rent prices falling, and that doesn't translate into lower housing numbers because they use the rent numbers to calculate those. If that were to finally take off and go down, then the Fed would feel a whole lot better about the inflation picture right now. But the good news is inflation has come down a lot, to the point where now for the last 6 or 8 months, Americans' average hourly earnings have outpaced inflation. Looks like the American people haven't noticed yet, but they're finally ahead of the game, and maybe they'll start to notice that soon.
Yeah, someone should tell them that it's it's looking good.
Hey, everybody.
Well, our next FOMC meeting, March 19th and 20th. So what are we going to get between now and then, or what is the Fed going to get to come to their decision?
We'll get another CPI reading, and we will also get the jobs numbers for the month. And we should get retail sales before that. So they'll have another month's picture. They'll have the February picture before they have to make a decision. We won't have the PCE index, which is the inflation number that they follow. And there's been a wedge between the CPI and the PCE that is partly based on the weighting of the things in the various categories. PCE's been running a lot slower, and it's much closer to the 2% goal that the Fed has, and they won't have that data. So expect March to be an on-hold meeting. They've kind of signaled that at this point. By the time we get to the meeting after that in May, there should be enough data that they can make a decision. But if it comes in contradictory as it has this past month, they may not be ready then either.
Well, it's a lot to look forward to. Well, our thanks to Bloomberg International economic and policy correspondent Michael McKee. And coming up on Bloomberg Daybreak Weekend, we're looking ahead to London, Milan, and Paris for Fashion Week as the luxury sector faces cooling demand for its products. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. The biggest fashion brands will be showcasing their designs across Europe in the coming days at the London, Milan, and Paris Fashion Weeks. These glitzy events are happening at a challenging time for many luxury names. So how are the world's most illustrious fashion houses protecting their profits while also prioritizing style? Well, for more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, it's a tricky time to be in fashion. Cooling demand for luxury products after the pandemic, along with slowing sales in China and higher inflation, have squeezed some key drivers of growth. This season of European fashion weeks are expected to be as glamorous as ever, with the fashion elite descending on London, then Milan and then Paris. While luxury giants LVMH and Hermes had good stories to tell in their most recent results with strong sales in key brands, there was less good news from the likes of Burberry, which issued a profit warning wiping the equivalent of almost $130 million off its outlook. I've been discussing all of this with Bloomberg opinion columnist Andrea Felsted and our European luxury reporter Angelina Raskowet. I started by asking Angelina how important Fashion Week events are to these big brands.
These events are very important because obviously you're unveiling and you're going to be showing your consumers what will be the trend. And obviously in the age of social media, you have influencers, celebrities who's got millions of followers. So actually the impact of these fashion shows are huge. And, but it's not just fashion shows. Obviously, I mean, if you think just about Miley Cyrus, like recently she was at the Grammys and she was wearing a Gucci, at some point she was wearing a Gucci gown with a bag. And that's very important for the brand. You think about Gucci, I'm going to be going to the show in Milan next week. It's a brand that it's in turnaround and it needs all the attention and the visibility it can get. They have a recently new designer. I mean, this is going to be his third show. So indeed, it's going to be, very important. But remember, there's always a lag also between the unveiling of a collection. So his first collection, Sabato de Sarno, at Gucci was in September, and it's now only hitting the stores right now. So there's always a lag, of course. So the financial impact cannot be assessed, obviously, right away. Right away, what you can assess is, the buzz, if a video goes viral. That's pretty much what you can assess.
And Andrea, that brings us very neatly to something you've been writing about recently when it comes to Gucci as well. Just the headline from your piece, Gucci can be revived, but it won't go viral. Tell us more about how you're thinking about the series of fashion weeks.
Yes, obviously Gucci, as Angelina mentioned, it's moving from its bold maximalism that it had before to this new, much sleeker aesthetic in line with quiet luxury. This trend that emerged around a year ago at the shows early last year, which sort of set the direction of fashion. Now, the worry is that we're having a bit of quiet luxury fatigue. So this could be potentially awkward for Gucci. I'm not sure that the new Gucci is really is distinctive enough to stand out in the way that the past designer Alessandro Michele did. It's also going to take a while, as Angelina said, to come through. So, yes, this will be really one to watch.
Miley Cyrus, not enough to revive an entire brand. Andrea, I wanted to ask you, though, about Burberry as well, because they made a splash in the last season of Fashion Weeks in September with their takeover of Bond Street Station, for example. But the company still saw a profit warning in its recent earnings report. Is this going to be a difficult showcase for Burberry? Do they need to turn around the vibes?
I think it's going to be just as sort of confident and exciting as September was, because what Burberry needs to do is, as Angelina mentioned, it's all about creating a buzz, creating a halo effect, and Burberry really needs to do that. So it's got some quite nice products coming through. It's got a lot of nice bags. Daniel Lee is really pumping out the products. There's a new trench bag, which is canvas, very much in line with the nylon bag trend we've seen. There's been a lot of narrative that Burberry has been putting the prices up, and that's putting people off. That's missing the point. What you need is brand desirability. It's starting to happen. Burberry's starting to move. There's a list index of the most in-demand brands that people are searching for and buying. It's started to move up gradually. I'm seeing some young people with the Burberry check bags, Burberry check scarves, often vintage. So that's really good signs. What it needs to do is it really needs to pump up that desirability. It needs to get those bags out to influencers so that we can follow and see them in, Instagram posts, TikTok videos, Pinterest boards. And I think when that happens, that it could be good for Burberry, because I feel that a lot of the turnaround stories, a lot of the brands are kind of they've been around for a while. I mean, Gucci was exploding around 8 years ago. The Miu Miu turnaround and the Prada turnaround are pretty well established now. I feel that there is room for something new and exciting. And if Burberry can get it right, that can be it. As you can tell, I'm the lone Burberry bull.
Angelina, I wonder, do you have a contrarian view on Burberry from what Andrea was talking about? Is that the big highlight from London Fashion Week that you'll be looking out for?
Yeah, so for sure, Burberry is definitely the most famous brand coming out of London Fashion Week, and the tricky bit with Burberry is that obviously being a publicly listed company, and it's not a group, it's only one brand, right? So it has to report results on a quarterly basis, and that scrutiny sometimes is very difficult for a brand that's in turnaround mode. I mean, Andrea is right. You have to be confident, and that about the designer. He wasn't named less than 2 years ago, and it doesn't happen overnight. So that's the tricky bit, and Burberry, in comparison to all the other groups, Yves Saint Laurent is part of one group. Loewe is part of a group. So you don't get the granularity of their performance on a quarterly basis, and that's actually the challenge for Burberry.
Because of course LVMH, another company that you cover, Angelina, is an absolute mammoth in this area and kind of covers a lot of ground in terms of brands as well. Does that allow for more space for underperformance then of certain brands?
Yes, I mean, and they're not, they have some mega brands like Louis Vuitton and Christian Dior, and some brands who started from a very small, with very small sales numbers, and now we know that they've actually grown a lot in the past 5 to 10 years. If you think about a brand like Loewe with the designer Jonathan Anderson, he's an Irish designer trained at the London College of Fashion, and he's done wonders at Loewe. We don't get the numbers of Loewe, but we know he's done wonders, and they're very happy with him. And it's the same thing with Celine, with Eddie Slimane. Again, we don't get the numbers, but we know these brands have fared very well. And actually, another brand that was at some point problematic. I mean, he said it in, I think it was more than 5 or 6 years ago in results that Marc Jacobs was struggling, and they managed to turn it around, and they're very happy with the turnaround that they managed to do. So, but being part of this wider group where you only have numbers by unit, not by brand, that is very helpful. That gives breathing room for the brands and for the managers who are in charge, and the designers as well.
Andrea, can you give us, since we're talking about London Fashion Week and then the European tour that follows with Milan and with Paris, what's your feeling around the British fashion industry post-Brexit? Has that posed challenges to it? Is that something that's led to a shift?
It really has. The loss of those tax breaks for overseas shoppers in London has really hurt the London fashion demand, particularly Burberry. It's another headwind that Burberry has to deal with, but across the board there are hopes that might be revived. It was difficult for the government to say we are giving luxury shopping a tax break when we had the cost of living crisis going on. Optically, it didn't look very good, but now that seems to be subsiding. There are hopes that can be reversed and that can breathe life back into London fashion sales.
Angelina, I wonder, when you think about the other shows that you'll be going to and the other brands that you'll be monitoring, what other highlights are you looking out for?
I mean, obviously, Louis Vuitton is always a big moment because it's the biggest luxury fashion brand, and so last month in January was the menswear show. So that was Pharrell Williams' third show for the brand since it's been named, second show in Paris. So now it'll be interesting to see what Nicolas Ghesquière offers for ladies, and when Pharrell Williams was named, people were saying, oh, maybe he's going to like take all the spotlight away from Nicolas Ghesquière. But actually, Nicolas Ghesquière, he's been at Louis Vuitton for 10 years, and they just renewed his contract. So it's a vote of confidence for Nicolas Ghesquière. And so for sure I'll be looking forward to that one. I'm still hoping to get my invite, but and then Hermès as well. I mean, Hermès is the Andrew was sort of mentioning the quiet luxury. Hermès is you could put it in that basket. I mean, it really caters to the most to the ultra high net worth individuals, and for many years we associated Hermès with leather goods, with handbags, and with but actually they've done tremendously well when it comes to ready to wear, and they have these two designers, two ladies, one for menswear and one for women's wear, and they've done wonders. But that one of course is it's less on logos, it's less on bold maximalism that Andrea was talking about. It's more on the quiet, but the think about clothes that you can their viability will last for over a season. Let's put it this way. And then otherwise, Dior is always an important one, of course. Maria Grazia Chiuri, she's been with the brand for many years, and actually she's done wonders as well for commercially.
Andrea, final thought from you. It's the 40th year of London Fashion Week, so it's a bit of a milestone as well. Have you kind of a particular view on where the next 40 years might be taking London fashion?
London's always been very innovative in fashion. When we think about, many designers come through St. Martin's, for example. London can be quite edgy as well. So I think that it's important to keep that, experimentation, edginess, to have a different point of view from some of the bigger capitals. And I think if Burberry can get it right, it can really reinforce that.
So that was Bloomberg opinion columnist Andrea Felsted and our European luxury reporter Angelina Rascouet. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, the Reserve Bank of Australia releasing minutes from its latest policy meeting, and we'll get a preview. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. In the week ahead, the Reserve Bank of Australia releases minutes from its latest policy meeting. That's when the RBA left its benchmark rate on hold after lifting it 13 times since 2022. Bloomberg's Doug Krisner and Paul Allen from the Daybreak Asia team on what it all means.
Tom, we know how rampant inflation was in many developed economies during the pandemic, and central bankers responded with aggressive rate hikes. In the last year, the stories seem to shift to immaculate disinflation. But that's no longer a given. As the recent U.S. CPI data show, price declines have stalled, and it's forced an adjustment to expectations for the number of rate cuts from the Fed and how aggressive the Fed may be.
Other central banks are facing a similar dynamic, and this week we might get insight into how the RBA views the inflation story. Minutes from the last meeting of the Reserve Bank of Australia scheduled for release on Tuesday. For a look ahead, we're joined by Swati Pandey, Bloomberg Australia economy government reporter. And Swati, we've got a big piece of the puzzle with the January unemployment numbers ticking up to 4.1%. I believe that's the highest in 2 years. 100,000 full-time jobs lost, a little bit more. Is that it? Can we say that tightening's now off the table for the RBA?
It was a surprising piece of data and a very important one as well, because the RBA has been looking at the jobless rate, and that was also one of the reasons why they have been hawkish. But the ABS has tried to play down that report by saying there is a lot of seasonality in December and January, January being a very popular month for people to go on holidays. rise, and also there have been some people who were marked as unemployed, but they were actually in between jobs. So we could see a revision in the unemployment rate, maybe going back down in February. So I would say it's probably too early to say that we are in a market where the labor market is easing. There are tentative signs, but overall, the RBA's assessment is that the labor market is still tight and demand is still exceeding supply.
That said, the labor market data did get the market's attention. We spoke earlier in the week with Charlie Jamison. He is the CIO of Jamison Coote Bonds. Here's what he had to say.
We need to be generating more employment in order to keep those numbers sustainable. There has been a lot of loss of momentum in the economy, as we said, and that's certainly different to what you guys are seeing in the United States at the moment, where the economy seems to have accelerated a little bit in the first part of the year, looking at employment and inflation data.
So it's brought forward now the notion of rate cuts from the RBA. Swati, is it too soon to talk about rate cuts?
It's actually not too soon, but if you ask Reserve Bank Governor Michelle Bullock, she would say it is too soon because they are still not ruling out interest rate hikes. That was her commentary last week. So they are not ruling anything out for that matter, but she's still sounding hawkish. She's still talking hard on inflation. Markets are now expecting some probability of an August rate cut. There are some economists who are expecting a June rate cut. A Bloomberg economist is also expecting a rate cut around May, June. So yes, it's still 3 months down the track, I would say.
What's the inflation story telling us right now?
So inflation is still well above the RBA's target. It still has a 4 handle to it. RBA's target is 2 to 3%. They are targeting the midpoint, 2.5%. So it is still at a level where Michelle Bullock is really uncomfortable. And that is one of the reasons her vague guidance, I would say, is for interest rates to remain elevated for longer. The RBA's forecast does not show inflation in the midpoint until 2026.
I was reading comments earlier in the week from Marianne Kohler, the head of economic analysis from the RBA, and one of the things she was cautioning is that inflation may be sticky. Paul, give me your perspective. You live in Sydney. What is it like, the cost of living right now? What are common people kind of dealing with in their everyday affairs?
Yeah, this is an interesting one that you raised because we had Michelle Bullock last week speaking to Parliament about this and questions about businesses using the cover of high inflation to start pushing up prices were raised. And look, certainly from an anecdotal point of view, and I'm sure Swati will back me up here, is if you just go on your regular grocery shop, you're just out and about doing things, inflation's running at, something above the RBA's target window, but you're buying things that might be higher by 50, 60, even 100% than what they were a year ago. Now, the two big supermarket chains in Australia, Coles and Woolworths, they're coming under fire as well for this type of thing. They're defending themselves against this accusation of price gouging. But, it's a hot subject in Australia at the moment, isn't it, Swati? Just how much consumers are paying for things and how that doesn't really square away with the official inflation rate.
That's absolutely right. Haircuts have become very expensive and it's eating out. Restaurants have raised their prices. I still would say that when you're out and about in Sydney, if you go to a pub on Friday, it's still buzzing, it's still teeming with people. So we are not really seeing that impact on everyday kind of lifestyle yet. We've not had a big impact on people really cutting down drastically on their budget at an aggregate level. I'm sure there are people at either ends of the spectrum who are very deeply affected. But if you are going out and about, it just feels like a normal day. During Boxing Day, in fact, around Christmas, shopping malls were chock-a-block. There were huge queues of cars waiting to park. And that was the time we were talking about a hard landing, soft landing. So it just did not feel like a a recession is coming, for that matter.
It's interesting because I think we have, just in listening to the conversation here, I think we have to discriminate between services inflation and goods inflation. And I recently saw that the IMF was recommending that the RBA needed to raise rates to tame inflation. Is the IMF looking more at the services side than the goods side?
I would say the IMF is looking at the services side, because that is something that Michelle Bullock and earlier Marion Kohler mentioned as well, that part of inflation is quite sticky, and their concern is that it will remain elevated for some time. And another concern that they have is inflation expectations. So if you allow inflation to remain higher or above the target band for a long time, it will unanchor or demoor inflation expectations as well, which right now is at 2.5 midpoint.
Well, we mentioned that Michelle Bullock, the RBA governor, was speaking with senators last week in Australia. She took questions on this. What was she saying about it?
She actually said that the IMF is not particularly talking about Australia. She said this is something they are talking about in general for developed economies, because inflation continues to remain a concern, but also as far as goods inflation is concerned, it's still too early to say that we have won that battle, because we have conflicts going on in parts of the world. There are supply chain disruptions that have again happened with the attacks in Red Sea. So even as far as goods inflation is concerned, Michelle Bullock is not willing to say that we have won the battle there.
So my understanding is that the RBA during its tightening cycle raised rates 13 times for a total of 420 basis points. The policy rate now is at 435. Paul, help me understand how that connects to the mortgage market in Australia.
The big four banks here often cop a lot of criticism for being incredibly quick to pass on increases to the cash rate to people who are borrowing money off them. And in a country like Australia, where house buying, auctions, practically a national sport. The tax regime is also set up very generously for people who want to buy investment properties. These sorts of interest rate moves really get people talking. There is a fair bit of competition, but if you're taking out a mortgage in Australia, yes, you do pay a lot more than you were a couple of years ago during the depths of the pandemic when interest rates were very, very low. And we saw property prices just absolutely taking off. Now, a lot of people took out loans when rates were at those low levels. Those rates have since increased, but we haven't seen a huge amount of mortgage stress. There's been very few forced sales, and certainly none of what was predicted at the time seems to have come to pass. Is that your observation, Swati?
Yes, absolutely. I would also like to add there that Australians are among the most indebted household in the world. So we have a debt to income ratio of roughly 185%. And that is one of the reasons it was expected that households would be very, very deeply hit by these interest rate hikes. But we had earnings from Commonwealth Bank of Australia earlier this week, and they had like $5 billion in profits. So clearly, we are not seeing that impact in defaults and non-performing assets for banks, at least.
So, Swati, I'm wondering whether or not when we get these minutes from the last RBA meeting on Tuesday, whether we're going to be able to learn anything here, whether it's going to be kind of a level of understanding that the market will have, or do we need to say that because of this very, very disappointing employment report that it's essentially all bets are off now? We're starting almost from a clean slate.
So, Doug, we will have a monthly inflation report next week. That is going to be critical for markets. And if that is showing a softer number, I think rate bets will be brought forward more convincingly than now. As far as the minutes are concerned, the Reserve Bank governor held her first press conference after the rate decision last week. And that went on for almost an hour. And a lot of the questions around her views on interest rates, inflation, and economy were answered. And then she also appeared in 2 parliamentary appearances. So I think as far as the RBA's thinking is concerned, we already have a lot of information from them. So not sure how much more the minutes are going to show, but definitely markets will be looking out for that monthly inflation number.
And Doug, I'm not sure if you're aware, we're actually in the presence of history here, because that was the first ever press conference by an RBA governor, and Swati got to ask the first ever question. So that caused a little bit of consternation among the media pack.
Swati, thank you so much for making time to chat with us. Swati Pandey, Bloomberg Australia economy and government reporter, and of course Paul Allen in Sydney, who is a member of the Daybreak Asia team. Thanks to you both. I'm Doug Krisner. You can catch Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia, beginning at 9 in the morning in Hong Kong, 8 p.m. on Wall Street. Tom?
Our thanks to Doug and Paul, and that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.